Jason, let's tackle the first name first, which you say is Uber. What is the disruption here? Instead of autonomous driving, we've got yellow taxis, continued losses. Is this a company that's really disrupting, or is it sort of settling into its status as maybe a taxi and delivery company?
It's a great question, Deirdre. Good to see you all. I would say that the big opportunity in Uber is that this company went public way too early, right? The stock has actually underperformed the S&P 500 by 90 percentage points since their IPO. When the company first went public, they were bleeding cash. The competitive environment was completely unsettled. The Eats business faced a lot of competition. Fast forward to today, they've really rationalized the portfolio. They've divested businesses where they are not share leaders. And now 90% of their rides business is in markets where they are number one. The Eats business has turned the corner and is profitable. The business structure overall is more attractive.
Hold on a second. A few things you said. You said that this is a company that went public too early. This was one of the oldest startups when it went public. It had raised billions and billions of dollars in private markets. And then you say that Eats is profitable. It's not. Maybe on an adjusted EBITDA basis, but barely so. And this company overall is still losing money.
Well, I mean, they're not going to lose money this year, right? I mean, we're looking at positive free cash flow. We're looking at, about $700 million in terms of adjusted EBITDA. I think that their targets of $5 billion in adjusted EBITDA in 2024 is going to prove very conservative. That represents only a 3% adjusted EBITDA margin on bookings. Look, this business went public too early from the standpoint of what did the competitive environment look like, right? It was unsettled. Their business was unsettled. Now they're gaining market share in the U.S. across their rides and their Eats business. We still haven't fully recovered post-pandemic. And at the end of the day, this is an asset-light business that operates in a number one position in a lot of their markets and duopoly in other markets. It's a stock that has underperformed. But it's a company that, really has the right to regain the mantle of one of the true tech leaders.
Interesting. Asset light, drivers are expensive, though, and so is gasoline. And one thing we haven't mentioned today is the Instacart valuation down 40% from the prior. I just wonder, should we be worried more about the ride business or the Eats business?
Look, I think all of this gets back to this rationalization that's happening. Capital is drying up, which is ultimately good for them. This is a positive inflection point in their business. And another thing that's super important about Uber is they have both the rides and Eats business. They can marry the two together and drive loyalty. Customers of theirs that use both the rides and Eats business are about 16% of their users, but represent over 40% of their bookings. They're rolling out Uber One. They already have 6 million subscribers, despite there not being, much promotional activity around it. And so this is an opportunity for them to really consolidate share. This is not a business. If there's anything that we've learned from looking at the financials of all these companies, this is not a business that can sustain many players. And everyone is sort of on board within the industry, all players that we need to start making money, right? So when you think about inflection points, that's what's happening in the ride share and the meal delivery business.